Let's start out with a look at the broad basket of commodity futures. And here we have the past few years of the Bloomberg Commodity Index, which is a broad basket of commodities ranging anywhere from industrial metals in that complex, energy to agriculture, and precious metals as well. And you can see that commodities have had a big run beginning with the pandemic in 2020, which culminated with the recent peak recently in 2022 on the back of the Russian invasion of the Ukraine, where fears of war-related supply disruptions affected a number of commodity prices there. And that led to the index rallying quite sharply in the first half of 2022 before coming back to trade more in line with what I thought to be the right supply and demand fundamentals. But the last few months of commodities have really trended down as we've faced macro headwinds around the prospects of slowing economic activity. And so today, when we take a look at it, and this is represented by the red line there, the index is now below its 200-day moving average. And in this setup, it's potentially a better and more attractive entry point for those who are still on the sidelines here. But I guess the question remains, where do commodities go from here? And you had a little bit of a glimpse on this, if for those of you who tuned in early at the top of the hour, where we do show snippets of past webcasts and other information that we had. And if you did tune in early, you probably saw me and Mr. Mayberry giving our rationale for investing in commodities. And this is more or less a persistent type of theme for investing in commodities. But the rationale of why you should hold strategic position in commodities in your portfolio is several. First, commodities can provide diversification to a portfolio of traditional financial assets. Secondly, they can act as a hedge against inflation. And then you have the opportunity to generate incremental returns in the space. And then lastly, as raw inputs, commodities generally participate in the global growth cycle. So you have the cyclicality of the global economy there. And we've seen each of these four reasons or rationale for investing in commodities really play out in this post-pandemic era. Drilling in for a closer look here, we have the diversification benefit. And you can see in that first row, I've outlined there in red, we have the correlation of the Bloomberg Commodity Index to a number of traditional financial assets that you're likely to have in your portfolios. And as we move across the top row, commodities have a low correlation to, you can see here, to both equities as well as credit in the fixed income space. They're largely uncorrelated to the U.S. bond aggregate there, and negatively correlated to both U.S. rates as well as the U.S. dollar against a basket of other developed market currencies there. But all in all, when we look at it against this cohort, that results in an average correlation of 0.18 to a basket of these assets that we have listed there again across the top row. And so when we think about diversification and the role it plays, with that type of exposure, it only benefits you if you own it before the need is required, or it largely benefits you if you're already an existing holder. And we saw that really play out through both 2021, but especially in 2022. Here you can see the Bloomberg Commodity Index over there on the far right, and on the top part of the panels here, we have the performance, the total return across various asset classes in 2022. On the right side, we have commodities. Moving from the right to the left, we have currencies, and then we have fixed income, and then we have equities. So kind of reverse order from what your eyes would normally read. But the Bloomberg Commodity Index, you can see there, a broad basket of commodities, was up 16% in 2022. The GSCI, which is more oil heavy than the BCOM, which is a little bit more equitable in the distribution across the various commodity complexes there for sectors. But the GSCI was up 26%. And this is all in the world where both the Bloomberg the Bloomberg U.S. bond aggregate, as well as the S&P 500, are both in the negative teens. So when we look at that again in the top panel, there really wasn't anywhere to hide outside of commodities and the U.S. dollar. The U.S. dollar being up 8% again on that against that basket of DM currencies there. On the bottom panel, we have thus far the year-to-date performance of these same asset classes in 2023. And we've had a little bit of what we like to call the other way around, bro, here at DoubleLine. There's been a reversal in performance with both broad commodity baskets now printing red for this short year-to-date period. And then you also have the traditional asset classes there, especially with the equity side, out to a strong start for 2023 thus far. With the Bloomberg commodity, the Bloomberg. We have the Barclays Agg on there, but the Bloomberg U.S. bond aggregate is pretty much flat on the year-to-date basis after starting January out with quite a bang. Some of that positive momentum has started to shift of late, especially in the fixed income space. So we do have a long way to go, and we'll just see how the rest of the year progresses here. When it comes to the inflation benefit, for commodities, commodities make some sense as a hedge for inflation, because commodities are really the building blocks for many of the things that we do consume on a daily basis. And to help illustrate this, we've overlaid the CPI, the Consumer Price Index, on a year-over-year basis relative to the Bloomberg Commodity Index. And here you can see that the relationship appears to be quite strong. We've seen that inflation-related data prints recently have been coming in higher than expected as well in the past few weeks, especially with both CPI and PPI beating expectations on the relevant data points that were printed last week, as well as retail sales were also beating expectations with last week's data as well. And then 2 weeks ago, we had the strong payroll and jobs data. So all of that bodes or at least indicates for a strong consumer over the next few data prints at least. So the question I think leaves us with right here is, where does CPI go? And to help think about this, our team from the multi-asset team, they created this chart based on scenarios of which way U.S. CPI inflation on a year-over-year basis could go. And on this, if you look at the left, we have the path of year-over-year headline CPI that has already taken place from the same time last year through its most current print today, which is January 2023, and that's represented by the solid blue line. And you can see for the most part, it's been in decline since it printed the high of 9%, it looks like, in June of 2022. From that most recent current print, our macro team, again, they break out various scenarios that CPI could take. The solid orange line there is for market-based expectations based on CPI fixings. And you can see that goes through the end of this year. And based on what you see there, you see a deceleration in year-over-year CPI. And that's expected to stall somewhat by June of this year, based largely on base effects. And then from there, it's kind of flatlined for the remaining 6 months of 2023. Now, the dotted lines represent scenarios for CPI using static month-over-month prints based on predetermined levels by, again, our macro asset team, our multi-asset team, I should say. You can see on one end, represented by that gray dashed line, which shows if month-over-month CPI was held steady at 0 through the rest of the year, then you would expect CPI on a year-over-year basis to dip to 0. There's no real surprise there. But on the flip side, if you take a look at the green dash line there, that's using the most recent month-over-month print of 0.52%, and just held there for the remainder of the year. You can see you still get that deceleration on the base effects out to June 2023. But from there, you can see inflation would get pushed back above 6% year over year. Now, both of these are kind of the bookends of the scenarios that the multi-asset team took in. They're a bit extreme based on what we're seeing today. But I would say that we're likely to see some type of average month-over-month print somewhere between that, let's call it the lighter orange color of 0.24%. And that happens to be the average monthly print looking at the last 6 months of 2022. And below that of the 0.52 that we saw in January. So somewhere between that 0.24 and the 0.252, I think is reasonable to think that inflation may shake out somewhere around there. So it is quite possible that inflation could creep back up in the second half of 2023 under one of those scenarios. And I do think commodity relation inflation could be the wild card there. So that brings us to the current case of commodities. Again, if you're listening to that kind of the double line on the hour at 1 o'clock, if you showed up early, you kind of heard the same rationale that we've been talking about, not just for the last year, but actually for the last 2 years. But what's new here is we have this new primary headwind, which is largely a macro one, and that's the uncertainty related to the path of economic activity, both here in the US as well as globally. I think a slowdown in economic activity is definitely one that can't be dismissed, but I do think a number of commodities have already begun to price that risk in, as we saw in the outset of the slides that I showed on the Bloomberg Commodity Index. But I think the counterpoint to a slowdown will really be this path of reopening in China and the potential for recovery there. Despite some of this near-term macro uncertainty, we do have longer-term drivers of supply and demand that could potentially make for another attractive year of performance for a broad basket of commodities. And just looking at this list in front of you again, I'll go through them, but many of these drivers are the same ones that boosted commodity prices back in 2021, in 2022 again, and I think that they're still in place today. So on the demand side, beyond just the near term, the world is still transitioning from this dependency on fossil fuels as an energy source to one where it hopes to rely on clean energy sources. There's been a consortium of 190 countries that have signed on to this into this Paris Climate Treaty. And together, those 190 countries have a stated goal of achieving net zero carbon emissions by the year of 2050. But in order to accomplish that, they're really going to need a significant infrastructure build out to get us there. And that inherently is going to be commodity intensive. And we've been saying for quite some time now that that's the irony of it all. To get clean, you got to really get dirty first. But that move to carbon neutrality is a double-edged sword because it requires not only that uptick in consumption of these old world commodities that do emit carbon emissions, and are bad for perhaps the environment when you're strip mining for metals there. But it also makes investments towards the future production of fossil fuels and industrial metals less attractive. The reason for that is there's reputation risk around ESG concerns and just trying to meet these carbon emission goals. So what that means is allocating capital to this industry, this old kind of old world commodity industry, that's intended really to be phased out over time. It's not going to be very attractive in terms of use of capital expenditures. So what we've really seen over the last decade or so is just miners and energy-based companies have shifted their focus from production of future commodity supply to more so look on the profitability based on a combination of really shareholder pressure to reinvest more in improving shareholder positions rather than the production of future commodities. So rather than spending capital on those new investments, they've really been focusing on trying to maintain shareholder value. So with that, supply side continues to be a bottleneck to the energy transition based demand. A lot of these commodities that are necessary for infrastructure build out are currently at low inventory levels, and they also have limited future production capabilities, just based on this underinvestment that I've been talking about here. And then finally, of course, you have that specter of supply disruption from geopolitical risk, which is always really lurking out there. The Russian invasion of Ukraine continues to leave supply chains in an uncertain position for many of these commodities. So taking a look at some of these drivers in more detail, here we have the total U.S. crude oil inventory, and you can see here that what I have on the page, and includes both the private side as well as the public inventory. The public inventory means the Strategic Petroleum Reserve here in the U.S. And the shaded fill represents the range of inventory levels going back 15 years. And that's those levels are indicated on the vertical axis there on the right-hand side. And the months of the year are across the horizontal axis over time. And the red line there at the bottom left-hand corner, I should say, shows where inventories have been in let's say, the first 7 weeks of the year or so. And you can see that the start of 2023 thus far, as shown as the seasonal inventory build, is really at the lowest that it's been in the past 15 years, by what looks to be more than about 100 million barrels or so relative to the previous lows when you're looking at the same point of time over the last 15 years. So it's not off to a great start for inventory levels. But here on the chart, we see the primary reason for those low inventories, and that's the sharp drawdown that you have in the U.S. Strategic Petroleum Reserves. Back on the title there, you can see it says back to all-time lows. It's funny, we used the same chart about 10 months ago now, actually 9 months ago, I want to say now, but we were talking about, back then, the title actually said U.S. Strategic Petroleum Reserves back to the 80s, and there was a question mark because that was kind of around the time when the Biden administration started to release the emergency reserves. But today it's actually surpassed that. We are back to the 80s, and now we're challenging it and asking, are we going to go back to all-time lows? For those of you who aren't familiar with the SPR, which stands for the Strategic Petroleum Reserves, you can think about it as our nation's emergency stockpile of oil that's there really to buffer against unexpected supply shocks that could come from natural disasters, geopolitical risk, or just other weather-related events. So, I mentioned it before, but in 2022, you can see that sharp drop-off. That's because we released 180 million barrels of oil on that so-called emergency release. I think the emergency was really the fact that crude oil prices got a little bit too high rather than there being a significant supply disruption there. So that's got us back to the reserves, to areas that we haven't seen since the 80s. What I'm going to do here is, rather than go more into the SPRs, I'm going to put a shameless plug here for me and Mr. Mayberry for our podcast that we have called Monday Morning Minutes. In there, we devoted 2 episodes to the Strategic Petroleum Reserves. That's episodes 41 and 100 and 103, 41 and 103 for those who want to take a deeper dive into the SPR. But back to this webcast at hand, here's the longer run look at inventories. You can see that some of these, let's see here. You can see that, similar to the Strategic Petroleum Reserve, that the inventory levels are just kind of where we were just off of 1985. So definitely the impact of the emergency release seen here. Now, this is going to look familiar, but to the crude inventory 15-year lows that we saw before. This time it's for the U.S. Distillate stocks inventory. And you can see those are also below their 15-year range. Not quite as drastic as it was for the crude inventory levels, but they still they're below nonetheless. But for those of you who are unfamiliar, distillates are effectively the refined oil products, something like heating oil, or the type of fuel, the grade of fuel that you might be using in your car or your truck, or even for commercial planes or just planes in general through jet fuel. So those are also at a 15-year low. And I mentioned earlier too that supply constraints are going to continue to be an issue moving forward. Here's one of the reasons plotted out as capital expenditures for oil and gas. These are investments that, again, would go towards the future production capacity of oil and gas in this chart as it's represented. And these are real, so they are inflation adjusted figures there. But as you can see, as I pointed out earlier, there's been a reluctance, for producers to really add to the amount of internal investments that they're putting towards that future capacity. And it's really been interesting to see the discipline shown by oil producers and gas producers despite high oil prices in the past few years. And again, that's largely due to a combination of the ESG and this transition to green energy, which makes the return of investment on these type of projects less attractive for the future of fossil fuel type of investments. And also, again, the adherence to kind of produce or prioritizing shareholder value. So This one is not unique. I'm going to front run myself a little bit here. It's not unique just to oil and gas. You'll see that it's very similar to what we're seeing in industrial metals as well. I'm going to skip that previous chart for the sake of time here, but when we take a look at what's called the crude oil stocks to use ratio, this ratio here provides an estimate for the number of days coverage, and that's based on the current oil inventory. And this is globally, it's not just the US, but global oil inventory for OPEC-based countries relative to the consumption of these OECD countries. So here you can see on the chart that we're just at about 29 days of coverage. You can see while it's been on the rise from the low that reached down to 26 days or so, it's still relatively low to history. One of the things that we hear a lot about in the headlines is OPEC, and those headlines can certainly impact crude oil prices over time, but oftentimes it does leave our commodity team here a double line. And I'd imagine elsewhere, just kind of scratching our heads, these headlines, because the potential real impact oftentimes is far less exciting than the headlines would make them out to be. But here what we have is the estimated production across various OPEC countries, and that's represented in the dark blue. If you take out the magnifying glass, you'll find this light blue shade, which is the amount of spare capacity by country. And you can see all the way over there on the right, it aggregates up to 1.6 million barrels a day of potential production capacity across these OPEC countries in what I would imagine would be a best case scenario. If you layer on that orange fill, that's 1.1 million barrels a day from Iran. That in itself, I think, is somewhat questionable, and it's probably lower than 1.1 million from Iran, just given production maintenance needs and the impact of potential sanctions. But overall, as I indicated, the headline often is sexier than reality, because as we saw in 2022, there was this kind of persistent fear in the background that OPEC could increase production to help lower prices, but the reported increase usually was in excess of what their spare capacity in actuality would be. So a little bit more noise from the headlines than actual news. Let's move on from this slide here, and we can talk about kind of the recovery of mobility, which is a key component of demand. Here we narrowed it out to air traffic, but overall transportation accounts for about 70% of energy needs from, I should say actually from the use of crude oil-based products. But here we do have air traffic growth, and you can see while this is indexed back to December 2019. We are somewhat below those, December 2019 levels, but across most regions, we're well on that path towards recovery. Perhaps if this continues, then we should start seeing back to these 2019 levels by some point this year. But the one exception here remains is the Asia Pacific region. You can see that largely has accelerated. More so in the last year or so, beginning with 2022. But I think with the reopening of China in the past few months, I do suspect this catch-up phase to begin in earnest here as travel starts to pick up, especially intra-Asia sometime in 2023. And that, of course, would lead to a boost in demand for jet fuel. And then here, we're going to switch gears from crude oil, and we're going to move into other areas that should benefit perhaps a little bit more from the clean energy transition that I was talking about before. Although it will boost the demand for crude oil products, I do think that for the build out of green energy infrastructure, industrial metals are probably going to be a little bit more sensitive. So what I have here are projections that are compiled by Morgan Stanley, and it shows the progression from basically fossil fuel dependence, or dominance, I should say, not necessarily dependence, but from fossil fuel dominance to renewable and hydroelectric type of energy sources. So you can see in 2020, coal and gas makes up nearly 60% of the total energy generation mix versus about 19% in the clean energy sources. By 2030, you can see that renewables and hydro really step up massively as a percentage. You can just see from the shaded areas there that it starts to to outgenerate in terms as a percentage of energy generation that of gas and nuclear. And then if you think about 2023, that big jump, it kind of makes sense because that is a key milestone to those to some of these climate agreements, largely that Paris Treaty agreement for the 2050 net zero, but 2030 is a key milestone there as well, kind of a checkpoint in terms of the progress. And then by the time you get to 2035, it's basically projected by the projections compiled by Morgan Stanley that it's going to be game over when it comes to which one will be the dominant energy source. And, as I talk through it and I think about it, that could give people question and pause and thinking about, okay, that's the death of demand for fossil fuels. That should be a headwind for fossil fuels. But I think the slide, as I'm talking through it, it kind of shows this tug of war that's going to be played out between crude oil supply and demand factors. I mean, if you think about it as the demand over the long run, it could wane, but it's still going to be needed during this transition period. I mean, that was a lesson we learned in 2022, especially in Europe, that you just can't flip a switch there. Petroleum-related commodities are going to be needed throughout this green energy transition in order to build out reliable sources of clean energy, something that we aren't quite there yet. So I think on the supply side, this adds to that underinvestment thesis that I was talking about in CapEx, because again, just from this, it looks less attractive from a return on investment perspective. So with that, I mean, you're likely to see a longer run supply demand imbalance that is and should be supportive for future crude oil prices in near and the medium term. On slide 24, we have estimated annual investments. I'm going to pass through it fairly quickly for the sake of time, but you can see over the next few decades or so, there's anywhere from a minimum of $1 trillion in annual investments that are required somewhere in 2023-24, out to just under $3 trillion in 2035 or so. So basically, that spigot of investment capital is going to be required over the next few decades in order to get us to that point where we adhere to the net zero neutrality. And here we have a shift to the industrial metal stocks, similar to what we saw of crude oil and distillate inventories. You can see that industrial metals inventories that we have here, I have aluminum, copper, nickel, and zinc. Those are each instrumental to the infrastructure build out. And you can see across the board, each of these are at or historical low levels of inventory, which really puts us out on a bad footing. It's a tough situation to be in when we look at the demand for some key industrial metals. Here I've got copper specifically. You can see the projected demand based on clean energy source. It's electrical vehicles is the EV. You've got wind demand, and you have solar. And when you take a look at each one of these alone, they're expected to double for demand over the next few years. And that's largely because of electric vehicles as a percentage of total motor vehicle sales are expected to exceed traditional conventional vehicles sometime in the next decade or so. And that's that chart on the left there. On the right there, you can see that for certain regions like China and Europe, they've already exceeded that expected path. So in some areas, we're right on kind of estimate. In the other areas, we are moving a little bit faster than projected. Across here, digging a little bit deeper again, is copper usage. You can see based on the type of car vehicles, you're seeing incremental increases in the amount of copper that's required per car. Conventional cars, somewhere around 35 pounds of copper. As you step into hybrid electric vehicles, you about double the requirement of copper. From hybrid to plug-in hybrids, you're adding on another 50 pounds or so, another 50 pounds to go up to battery electric vehicles, which are your Teslas. And then that's surprisingly fairly similar to the amount of copper that's required for hybrid electric vehicles, or hybrid electric buses, I should say. And then, of course, with a full battery electric bus, you're talking about 800 pounds or so. So demand of copper moves up quite high. And then from here, you can see the amount of CapEx, very similar to what we saw for crude oil, same reasons. I won't belabor that point. But one of these things that I've said, in the past, there's really, obviously there's no commodity printer like there is a money printer over at the Fed. So there's no commodity printer out there that goes brr, to generate money overnight. Instead, a lot of these projects, the petroleum, the crude oil projects, the industrial mining projects, those are all long cycle projects that can take anywhere from a decade plus to go from that decision of whether or not to drill, to bring it to extraction, and to basically refining the first usable products. You can see anywhere from 10 to 15 years in those long cycle projects before you actually are able to pump out usable gas or extract and refine usable metals there. So while Europe was largely spared an energy crisis in 2022, largely because of Mother Nature, that's an example of how quickly sometimes these commodities are needed, but because of these underinvestment in these production capabilities, you can't just turn the spigots on there. And then finally here, before I pass on to Mayberry, is just the demand for nickel. Very similar in terms of the output demand for electric vehicles. You can see it rising and more than doubling over the next few years. So that's where we are in terms of the state of some of the fundamental and demand and supply drivers of why someone should consider investing in a broad basket of commodities.